We welcome back Chuck Zodda from the Armstrong Advisory Group for our weekly discussion about the latest financial headlines. And Chuck, let's start off with Alphabet, aka Google stocks. They started to soar today after a big ruling that won't force the company to sell off its Chrome browser. So, how do you see this ruling affect the company long term?
Well, I think the big thing was in the first phase of this trial, the judge who was presiding over it found that Google had engaged in anti-competitive behavior, effectively by paying to be the browser, the default search engine rather, for Apple devices. This, in the remedy phase of the trial, he pretty much said, look, even though I found that to be the case, this is an evolving landscape, and so I'm not going to prevent Google from doing that in the future. So this kind of took some of the worst case scenarios off the table, both for Google stock and Apple. Remember, Apple gets paid almost $20 billion a year by Alphabet in order to do this. And so as a result, you've got both of those stocks with some significant gains today. And it kind of, at least in this trial, pushes off any prospect of, a major issue, at least for the foreseeable future. Now, there is a second antitrust remedy trial that's going on right now that Alphabet is still party to. And so there could be something that comes out of that on the advertising side of things. But at least in this one, unless there is a successful appeal by the DOJ, it appears that Google is going to be getting out of this without any major problems.
What's interesting too, Chuck, is that there is a report out today that American companies are actually beating profit expectations. And some of this is due to cutting jobs and raising prices. And while this may be good for big business, what effect could this still have on the economy long term?
Well, it's something where I think if you look at, the way that an economy grows in a healthy manner, it's job growth and productivity growth that tend to, lead to a higher standard of living. And I think the questions that are out there are, hey, if job growth is slowing and we're still not seeing these huge productivity gains that people are hoping from AI, it's something where you do have questions about, hey, is there actually an improvement in the standard of living that's going on? Or is this, kind of more smoke and mirrors? But again, these things, we go through these phases every year or two where, this looks good, that looks bad. And I caution people to read too much into it or not to read too much into it, simply because just because companies are profitable for a year or two or more profitable for a year or two, it doesn't necessarily say anything about where the economy is going to be 5, 10, 15 years from now. This could just be a little bit of a short-term wiggle that we're seeing. And so I don't know that you can take too much out of this here.
And additionally, U.S. job openings dropped, defying expectations that it would hold steady. And it feels like every week the word recession comes out of my mouth in the form of a question, Chuck. And recession has been thrown out there for a while. That's the reason I do it. Where do we stand here on that concept in our current present times?
I don't think we have any conclusive data saying that, hey, we're either heading into recession imminently or that we're going to be avoiding it in the next few months. So I think we continue to be in a situation where we need to collect more data and see what the economy is doing. Certainly, the labor market is pretty stagnant right now. Talk to anyone who's looking for a job, and they'll tell you that it's slim pickings and slow moving. But the labor market is not the only piece of the economy that matters. And there are other parts that are still moving at a little bit more of a robust clip. And so I think that in the aggregate, there's nothing pointing to the US being in recession today, but there are questions that still need to be answered over the rest of the year that'll hopefully give us a little bit more in terms of clues as to where we're heading and whether the economy is weakening more broadly.
Let's wrap things up. I'll bring in coffee into the mix here to close things out. Starbucks just announced that it's using AI for counting its inventory. Do you think we'll see a drop off in AI use at some point, or will it flood the market as an investment at some point?
So, really interesting question. And I think that two things are true that are kind of contradictory. I still think that we're very much in the early adoption phase for AI. So I think there's going to be a ton more spending and a ton more in terms of proliferation of AI and AI based tools in many businesses. Despite that, I think there are also signs that the companies that are building the backbone to AI may be over investing in capacity in terms of their spending, similar to what we saw back during the original tech bubble, where the companies that built out the internet, a lot of them ended up not doing particularly well. A number of them went out of business. We still use a lot of the fiber that they laid, a lot of the backbone for the internet today, 25, 30 years later, even though those companies are gone now. And the question that I do have is, look, when you're spending 400, $500 billion a year on data centers to power AI, how is that going to pay for itself? I just don't know if there's the revenue there to do so. And so I think this is the question that's out there where, hey, how can AI grow significantly, but those also not necessarily pay for themselves in terms of the data center construction? That's an interesting question to consider here as we, kind of see how this evolves. But no, I still think there's a lot of room for growth as far as AI spending. I'm just not sure it's enough to cover all of the capital that's being spent to build out these data centers.
One of the many developments that we'll continue to keep an eye on in the weeks to come. Chuck Zodda from the Armstrong Advisory Group. Appreciate the time as always.
All right, Joe, have a good one.